Welcome to the deep dive. Today our mission is really zeroing in on one of the, well, truly critical players in the global energy shift for solar.
The thin film giant, yeah.
Exactly. And we're plunging right into their Q3 2025 updates. The source material we've got here, it's quite a mix, incredible top-line growth alongside some, let's say, pretty high-stakes legal fights.
Right, and then when you dig into these reports, it's immediately clear, isn't it? You're seeing a company trying to build this fortress, really both physical and financial, right here in the U.S. market.
While everything else is shifting around them.
Exactly, while the whole geopolitical landscape just shifts under their feet. It's about finding that signal in all the noise. So this deep dive, it's really about getting how they manage these record revenues.
Earth-shattering, yeah.
While also, fighting these huge trade battles, dealing with supply chain threats, and even major customers defaulting. It's a lot to juggle.
Okay, so our roadmap today. We'll unpack that surprising financial picture, definitely dissect the intense global policy stuff that's shaping solar right now, and try to understand where First Solar is really placing its bets with its thin film tech. Okay, let's unpack the Q3 2025 scorecard first. The top line is, frankly, booming. Net sales jumped 79.7% year over year.
Wow.
Yeah, soaring from about $888 million to a massive $1.6 billion. I mean, that kind of growth, you have to pay attention.
It's phenomenal scale, really. And the analysis, it highlights that this growth was driven almost entirely by volume, just pumping out modules.
Right.
Module volume sold to third parties increased by 79.1%. So they're successfully, churning out product and getting it out there. Plus, they also got a bit of a benefit from clearing up a prior year revenue issue linked to some earlier manufacturing problems. So that makes this quarter look even cleaner.
Okay, got it. And net income, that followed suit.
It did. Jumped by $143 million. Landed them a diluted EPS of $4.24. Pretty strong.
But here's where it gets, I think, really interesting. The core financial contradiction, you could call it. If revenue is up nearly 80%, why did the gross profit percentage fall off a cliff?
Yeah, that's the key question.
It dropped significantly.
Yeah.
By 11.9 percentage points. From like 50.2% down to 38.3%. That's a big drop.
That margin compression, that's probably the single most important metric on this whole scorecard, because it really exposes the fragility maybe of the current revenue model.
So what did the report say? What's behind that?
Well, what we found points to two main drivers. One is kind of predictable friction, higher logistics, detention, demurrage charges. Basically, it costs more to move huge volumes around these days.
Right, the cost of doing business at scale. Commodity risk, almost.
Exactly. But the deeper, more strategic insight is really the second driver.
Yeah.
They had a lower sales mix of modules that actually qualified for that Section 45X tax credit in Q3.
Yeah, the big one, the IRA credit.
The big one. That's the government's, 17 cent per watt bonus designed to push domestic manufacturing.
Yeah.
So if they miss the optimal sales mix for those qualified modules, that margin just collapses instantly.
Wow.
It really proves how surgically dependent their profitability is right now on maximizing that single tax credit.
And you can see the power of that credit elsewhere too, right? Like on their tax rate.
Absolutely. Look at their effective income tax rate. It plummeted to just 1.0% in Q3 2025. I mean, that credit, it's basically the lifeblood of their financial efficiency right now.
Okay, so moving from that, let's call it financial dependence, to the actual physical side. Their operational scale is, it's huge. Total Q3 production hit 3.6 gigawatts, and 2.5 gigawatts of that came from their U.S. facilities alone.
Right, and their total installed nameplate capacity is now around 23.5 gigawatts. Plus, you mentioned earlier that new Louisiana facility is starting its production runs, plant qualification.
So that really speaks to an aggressive strategy. Yeah, securing that domestic supply chain, building that fortress you mentioned.
Exactly, building that physical fortress.
Right.
And that scale, it translates directly into, future revenue visibility. Their contracted backlog as of late October 2025, it stands at an incredible 54.5 gigawatts.
Wow. 54.5. And what does that translate to in dollar terms?
That represents an aggregate transaction price of $16.4 billion, extending out through 2030.
$16.4 billion. In future revenue. I mean, that makes them sound almost impenetrable.
It sounds like it.
But this segment also reveals some major turbulence right smack in the middle of that backlog, this Dramatic contract termination.
Yeah, with a major oil and gas customer, BP Solar Light Source
I
specifically.
like big name.
It is. And it's a powerful demonstration of just how quickly these massive utility-scale deals can, well, unravel.
Well, what happened exactly?
The analysis confirms that various master supply agreements they had with that customer were just terminated. The reason cited was the customer failed to cure breaches of their contractual obligations.
And the consequence.
Shocking, really. They immediately had to reduce their contracted backlog by 6.6 gigawatts.
6 gigawatts. Gone.
Gone. Representing a $1.9 billion loss in that future transaction price.
Wow. I mean, that's the size of some companies' entire backlogs, just wiped out in one go.
Pretty much.
So what was the immediate fallout? Financially? Legally?
Well, they moved aggressively. The company immediately recognized $61.0 million in termination revenue. That came from advance payments they had already received.
Okay, so they kept the deposit, basically.
Essentially. But they're demanding a lot more. They filed a complaint in the New York Supreme Court. They're demanding payment for the remaining termination amount. That's $323.6 million, plus other outstanding receivables. So yeah, this is no quiet cancellation. It's an active, multi-hundred-million-dollar legal fight.
And it really shows how maybe fragile the foundation of these long-term utility contracts can actually be.
Exactly. It reveals how soft that foundation might be, even for deals worth billions.
Okay, so while they're fighting these contract wars in court, they're also investing heavily in their core tech, right? The future.
Yeah.
Let's look at their roadmap. What's operationally significant about their current technology bets?
Well, they seem to have this classic dual-track strategy going on. Short-term focus is on something called the Copper Replacement Program, or CURE. C-U-R-E.
Okay.
Now, for first, solar's cadmium telluride, that CDT thin film, to really compete against the dominant silicon PV market, it has to maximize its inherent advantages.
Right. Things like performance in hot climates, that sort of thing.
Exactly. So CURE is intended to enhance module performance, specifically improving bifaciality, getting power from both sides, and the temperature coefficient, factors where CDT already kind of excels. They actually sold initial CURE modules earlier this year, and they're planning phase replication across certain factories starting early next year. So this is really about maximizing the current generation tech.
Okay. Optimizing the present. And what about the longer-term defense, the future replacement technology?
Right. That's where the dedicated investment in perovskite research comes in.
Ah, perovskites. The sort of holy grail material everyone's chasing.
Kind of, yeah. They're building a dedicated development line in Ohio, focused entirely on increasing the efficiency and, crucially, the stability of this next-gen thin film tech.
Stability is the big hurdle there, isn't it?
It is. If they can solve those inherent stability issues with perovskites, they could potentially leapfrog the efficiency curve while still keeping their thin film manufacturing advantages. Big if, though.
And naturally, to protect both the current stuff and this future potential, they're aggressively defending their intellectual property.
Oh, they absolutely have to, especially in this premium U.S. market they're trying to dominate. The reports detail continued enforcement against competing high-efficiency silicon technologies, specifically Tito-Pecan IP rights.
Who are they going after?
They've got ongoing lawsuits against Jinko Solar, Mundra, that's an Adani affiliate, and Canadian Solar, all filed in the U.S. District Court for the District of Delaware.
So they view their IP almost like a non-tariff barrier, something to protect their niche.
I think that's exactly how they see it. It's crucial for maintaining their market position, especially against lower-cost imports.
Okay, so if IP is one kind of barrier, government policy is like a massive, constantly shifting wall. We know the benefits of the IRA's Section 45X credit, that 17 cents per watt, is clearly foundational for them.
Absolutely.
But what new headwinds are suddenly popping up? Things impacting their strategic planning now.
Yeah, they're dealing with some genuine policy whiplash right now, it seems. The reports highlight this recently signed bill, H.R. 1, the One Big Beautiful Bill.
Right.
It introduces some major risks for them. Not only does it accelerate the termination of older credits like the ITC and PTC, but crucially, it restricts the 45X credit eligibility itself if the component is linked to what they call a foreign entity of concern, or EOC.
Okay, that FEOC clause. That's aimed squarely at decoupling the supply chain from certain geopolitical rivals, mainly China, right?
Primarily, yes.
But what does that mean practically for a company like First Solar with complex global supply chains, even if they assemble here?
It means massive uncertainty, huge headache. Even if your final assembly is domestic, The sourcing of all your components, your inputs, it has to be perfectly clean of VOCs. It's really complex to trace.
Mm.
And this is compounded by other active investigations like the Section 232 probes into polysilicon imports and the decision to suddenly raise copper tariffs to 50%. The legal goalposts are just moving constantly.
Yeah, it sounds like a nightmare for long-term planning, threatening to undermine these multi-billion-dollar domestic investment plans they've announced.
Precisely. The stability they thought they had from their IRA is now being chipped away at by these new rules and investigations.
Okay, let's look outside the U.S. for a second. Where are the trade barriers hitting their international manufacturing facilities hardest? You mentioned India earlier.
Right, India is a prime example of a market really strengthening its domestic position, using non-tariff barriers. Specifically, their approved list of models and manufacturers, the ALMM.
ALMM.
Right, they're expanding those ALMM requirements. Soon it'll include solar cells by mid-2026 and potentially even wafers by mid-2028.
So locking down their domestic market, how does that affect First Solar's plant there?
Well, actually, First Solar seems well positioned there. Their India production is reportedly fully compliant with all current and future contemplated ALMM regulations. So they actually retain privileged access to that large Indian market, which is a strategic advantage.
Interesting. But the global supply chain, you hinted at it, has a potentially major Achilles heel for this specific company, centered on one particular material.
It really does. It's tellurium.
Tellurium, okay.
Mm-hmm.
Why is that such a unique risk for them?
Because it's a primary component, a key ingredient in their specific CDT modules. It's fundamental to their tech. And the reports highlight this specific, unusual, and frankly, critical risk. China is tightening export controls on 5 key minerals.
And tellurium is one of them.
And tellurium is one of them. This is a massive vulnerability for First Solar. Huge.
So what are they doing about it?
Well, they're actively seeking the necessary export licenses from China, but perhaps more importantly, they're simultaneously working hard to develop non-Chinese sourcing options for tellurium.
They have to.
They absolutely have to. If that specific supply line from China gets choked off, their entire thin film production model faces an immediate, profound threat.
Okay. And one last piece on the global picture. The reciprocal tariffs on finished modules. If you're First Solar manufacturing overseas, where are the tariffs hitting hardest right now?
Yeah, the cost of their international manufacturing is getting slammed by these high reciprocal tariffs when trying to import back into the U.S. or other markets. The rates are severe. Vietnam at 20%, Malaysia at 19%.
And India?
India is particularly bad. It's 25% base, but then it faces an additional 25% tariff imposed specifically over its purchases of Russian oil.
Wow, so 50% total.
Yeah, resulting in an overall tariff rate of 50%. That creates an incredibly high hurdle for exporting any Indian-manufactured modules back into, say, the crucial U.S. market. It really complicates their global manufacturing strategy.
All right, so with all this external chaos, the volatile geopolitics, the trade risks swirling around, we really need to look at their internal financial fortress. How strong is it? But first, let's quickly address an internal quality check issue, this new warranty accrual. What happened there?
Right. So the reports did identify some manufacturing issues. They're affecting certain Series 7 modules, specifically from the 2023 and 2024 vintages. Apparently, they might cause premature power loss.
Okay, not ideal when you're scaling up fast.
Definitely not. It's an immediate quality risk they had to address. So they responded by recording a specific warranty liability of $65 million.
$65 million.
Yeah, that's their best estimate of the potential losses, though they note the range could be somewhere between $50 million and $90 million.
So it shows that scaling production that quickly, it often comes with these kinds of, well, unavoidable quality control challenges that you have to quantify and, importantly, pay for.
Exactly. You have to bake that risk in.
Okay, so given those internal fixes, the ongoing IP fights, the trade wars, how strong is their balance sheet? Can they actually sustain this multi-front battle?
This is really the ultimate counterbalance to all the volatility we've been discussing. The balance sheet looks rock solid.
Right.
Cash and marketable securities rose to $2 billion. That's up from $1.8 billion at the end of 2024.
$2 billion in cash. That's a significant cushion. Where's that liquidity surge coming from? Module sales?
Partly, yes, but a huge driver is the direct result of successfully monetizing those IRA benefits we talked about.
Ah, selling the tax credits.
Exactly. They sold $1.56 billion worth of Section 45X tax credits through agreements made in 2024 and 2025.
Wow.
They essentially injected massive amounts of government-backed cash directly into the business, and that's what's funding their expansion and, frankly, their defense on all these other fronts.
So they literally use the IRA benefits to build a financial shield against all this instability.
Precisely. That's a
Yeah.
great way to put it. And just a quick final note on their long-term commitments. They also maintain a $145.1 million liability for solar module collection and recycling.
End of life stuff.
Right. And importantly, that liability is entirely backed by $215.5 million they hold in restricted marketable securities. So that environmental commitment, it's fully funded and completely ring-fenced. It shows real operational and financial discipline, even with everything else going on. Hashtag outro.
So putting it all together, Q3 2025 really confirms that First Solar isn't just a major beneficiary of U.S. industrial policy, though it certainly is that. It's also an aggressive market participant, forced to navigate this dizzying, complex, and highly litigious global landscape.
Yeah, the core theme that comes through is survival through, I'd say, diversification and policy leverage. Their strong balance sheet is crucial. Their heavily focused U.S. manufacturing capacity is key. And having that strategically compliant India footprint provides critical buffers.
Right.
However, their ability to actually convert that enormous $16.4 billion backlog into real profits, it really hinges on two deeply interconnected risks we discussed.
Which are?
One, stable interpretation and enforcement of U.S. tax policy, especially that 45X credit. And two, successfully defending against that unique China tellurium export control risk. Those are the big ones.
It really is an unprecedented multi-billion-dollar high-wire act they're perfecting. I mean, they have this huge backlog stretching out to 2030. But how stable is a $16.4 billion future revenue stream when we just saw a major customer default on 6.6 gigawatts of commitments?
Right.
And the legal landscape around tariffs and tax credits remains this volatile. It feels shaky.
And that, I think, is the ultimate systemic question here, not just for First Solar, but for the entire utility-scale renewable energy sector. If even a cornerstone deal worth nearly $2 billion can be unilaterally terminated like that, it kind of reveals that the contractual foundation of this whole energy transition might be much softer than a lot of financial models assume.
So the provocative thought for you, the listener, might be, what foundational stability beyond just individual company balance sheets do governments need to introduce to make sure these massive long-term infrastructure contracts are actually enforceable and reliable? Because right now, that uncertainty seems baked into every single large-scale solar project worldwide.